Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at a couple of pieces of fallout from the property market slump. We're now seeing a sharp acceleration in rentals as property investors look to boost their yields to compensate for the end of the era of capital gains. And we'll look at the first of the likely victims from a sharp fall in the number of houses sold each month. That's the real estate agents and the mortgage brokers, who depend on a cut from each deal to survive. But firstly, let's look at rentals and signs they are accelerating. Figures compiled by Massey University showed the median rental increased 3.4% in the space of just 3 months. Over the year, the median is up 7.1%, and that's more than double the inflation rate. Some areas are seeing really big increases. Rents in Invercargill rose 18.7% in the last year, and were up 15.3% in Lower Hutt. Napier rents rose 12%. So what's happening here? House prices are dropping and the economy is slowing, but rents are rising. It just doesn't seem to make sense on the face of it. But let's delve a little deeper. In recent years, many property investors bought rental property in the hope of big capital gains. They also didn't mind making a loss from the property itself because they could use that loss to offset against their regular income and pay less tax. They assumed they'd make it all back with the capital gain. Some landlords were receiving yields as low as 2 to 3% on their properties as recently as last year. Now that the era of easy capital gains is over, and landlords are looking for ways to increase their yield. Falling house prices will help, but landlords also face high rates and high mortgage costs, so they're increasing their rents. You'd have to suspect that rents are likely to rise more than 10% this year. That's another piece of bad inflation news for the Reserve Bank, and is another factor meaning it's unlikely to cut official interest rates this year. And now for some more fallout from the housing market slump. There were around about 20,000 real estate agents working at the end of last year. That number has jumped sharply in the last few years as the housing market boomed and volumes surged. Now that volumes of home sales are down 30 to 40% each month from a year ago, you'd expect a good number of these agents to chuck it in. They rely on commissions for most of their income, so fewer sales means lower income. You'd have to expect a good 5,000 to 6,000 would leave the industry in the next couple of years. The other angle here is that mortgage brokers will also feel the pain. Most of their business is generated by real estate deals, not just people rolling over their mortgages. Most people hunting for a new mortgage are moving house or buying for the first time. These brokers also receive the bulk of their revenues in a commission on each new mortgage written, and the amount of money they get from trailing commissions is dropping. So when there's a 40% drop in the number of new mortgages written, then that will reduce their income. I'm Bernard Hickey from interest.co.nz with the daily briefing. See you on Wednesday.